All right, today we're going to talk about something really fascinating. A brilliant piece of financial strategy that used to be the absolute gold standard for wealthy families. It's called the AB Trust. Its story is all about protecting wealth, some super clever planning, and, get this, how one single change in the tax law can pretty much reshape an entire industry. Okay, let's dive in.
So let me just ask you this. Imagine you've worked your entire life, you've built up a really significant nest egg, and you want to pass it on. How do you actually protect a multi-million-dollar estate from getting hit with a massive tax bill? That's the core problem we're going to solve today.
So first up, we need to set the stage. We have to understand the opponent in this whole story, the federal estate tax. This is the reason why a big inheritance can shrink, and I mean shrink by millions, before it ever gets to your family.
Now, to make this really concrete, let's use an example from our source material. Let's say we have a married couple, and their combined estate is worth $20 million. That's a fantastic legacy for sure, but it also creates a pretty significant tax challenge.
Okay, so when the first spouse passes away, there's this thing called the unlimited marital deduction that kicks in. And what that means is a surviving spouse can inherit the entire $20 million without paying a single dime in estate tax. Now, that sounds great, right? But what it really does is just kick the can down the road. The problem isn't solved, it's just been delayed.
So what happens when the second spouse passes away? Well, that's when the estate faces the full tax bite. See, with just one big estate, the government takes a hefty chunk. In this scenario, we're talking over $3.6 million that just goes straight to federal estate tax. What's left goes to the heirs. It's a huge loss, and it's exactly why families started looking for a better way.
And for decades, there was a better way. Enter the hero of our story, the AB Trust. This was this ingenious strategy designed specifically to tackle this exact tax problem for married couples.
So what exactly is it? Well, an AB trust, sometimes called a bypass or a credit shelter trust, is a joint trust that does something really clever when the first spouse dies. It splits in two. And that simple split, that's the key to all of its tax-saving power.
All right, let's break down how this split actually works. The main idea is super simple. Instead of leaving everything in one giant taxable bucket, you strategically divide it into two. So here's the play-by-play. First, the couple sets up one joint trust. Simple enough, but when one of them passes away, that's when the magic happens. The trust divides. Trust A, that's the survivor's trust, and it holds the survivor's assets. But Trust B, the decedent's trust, that one gets funded with an amount equal to whatever the deceased estate tax exemption was. And that is the crucial move.
And here is the absolute genius of Trust B. The surviving spouse still gets to benefit from it. They can live in the house, they can receive income from the assets, but, and this is key, because they don't technically own the assets in Trust B, that money completely bypasses their own estate for tax purposes. It basically uses the tax exemption of the first spouse to die, making sure it doesn't go to waste.
For years, this was the go-to strategy. The AB Trust was king. But then came the plot twist. A fundamental change in U.S. tax law that just completely altered the entire landscape of estate planning. To really get the shift, you have to see where we came from. Back in the early 2000s, the federal estate tax exemption was only about $1 million. With an exemption that low, even moderately wealthy families absolutely needed an AB trust to protect their assets. Now, let's fast forward to today. For 2025, the exemption is projected to be nearly $14 million per person. Just think about that jump for a second. This one change, by itself, dramatically cut down the number of estates that would ever even be subject to the tax. But that wasn't the only thing that changed.
The other huge game changer was this new concept called portability. What this provision does is it allows the surviving spouse to simply add any unused part of their deceased spouse's exemption onto their own. It's a much simpler way to get to a similar goal.
And the difference is just stark. Before portability, if a couple didn't use an AB trust, that first spouse's exemption was just gone, lost forever. But with portability, the surviving spouse can combine both exemptions, effectively doubling the amount they can pass on tax-free, and they can do it without the complex structure of an AB trust. So naturally, this leads us to the big question, right? With these massive changes, are AB trusts totally obsolete? Have they gone the way of the dinosaur? Well, for the vast majority of families, the answer is pretty much yes. The combination of these sky-high exemptions and the sheer simplicity of portability means the original tax problem that the AB Trust was designed to solve, well, it just doesn't exist for most people anymore.
And this number right here really drives that point home. By using portability, a married couple in 2025 can pass on nearly $28 million completely free of any federal estate tax. That covers all but the absolute wealthiest estates in the entire country.
But, and this is a really important but, less necessary does not mean useless, not at all. The AB Trust still has a vital role to play in certain situations. For those ultra-high net worth estates that are bigger than that $28 million threshold, it's still a powerful tool. It can also offer some serious asset protection, and maybe most importantly, it gives the first spouse control over where their share of the assets ultimately goes. That's a really big deal, especially in blended families.
You know, the story of the AB Trust is just a perfect reminder that the world of finance and tax law never, ever stands still. A strategy that was absolutely essential yesterday might be less relevant today. And that kind of leaves us with one final thought. Tax laws are always changing. So, is your financial plan built not just for today, but for whatever comes next?